Good afternoon. This is Jim Denholm, founder and CEO of Ironbridge Private Wealth in Austin, Texas. This is our strategic growth video podcast for Thursday, September 28th, 2023. We're going to go over a few topics: S&P 500, Russell 2000 small caps, look at a cross asset class chart, talk about commercial real estate delinquencies, look at GDP for the third quarter, and talk about scenarios that we think might be happening going forward and with probability. So let's go ahead and get started. S&P 500, we saw a year-to-date peak here in early August. We've had an 8% pullback so far, and frankly, it's been pretty orderly. We haven't seen, it's outside of a couple of days last week following the Fed decision to pause interest rate hikes. We saw a couple of big down days. This overall correction looks pretty normal, frankly. We've got an 8% pullback that's been orderly. We've got this rising trend channel. This would be a very logical place for this correction to stop. We've got the rising trend channel, and then this support and resistance area in the blue shaded box. Multiple times in early 21, it kind of stopped and reversed. Same thing in second quarter last year, third quarter last year, in the spring, multiple times. For whatever reason, this 4,200 to 4,300 range, the market is respecting. So a breakout and a retest, this is pretty textbook correction at this point. So let's watch. If it can firm up here, it does increase the likelihood that we could see a fairly decent fourth quarter. So positive developments despite an 8% pullback over the last couple of months. Looking at the Russell 2000 small caps definitely tells us a much different picture. The decline last year was very similar to the S&P. But the difference here is what happened in the spring following these bank failures. The Russell 2000, this is a textbook range-bound market. So if we look all the way back, 190, we're a little bit lower than that right now, but 190, that was happening, that price happened on the Russell 2000 in early 22. We're going 17, 18 months of very, very choppy sideways market. This in and of itself tells us a few things. One, it tells us that it's very obvious the big stocks in the S&P 500 are driving returns of the large cap indexes, and we just aren't getting that in the small cap, mid cap, equal weight area. So the majority of the stocks in the stock market are not performing all that well. The large cap, 7 largest stocks are performing well. The rest are not necessarily doing all that great. That's one thing that it tells us. The second thing that it tells us, which is a little bit more important, is the direction that this overall consolidation breaks is going to be very important for the broad market. So if we get a rally in the fourth quarter and we can break above this 200 level on IWM, which is the ticker, and break up out of this range, that should have very positive developments and positive consequences for the broader markets in general. However, if we do break lower, that also has pretty big implications for the broader market. One of the differences to note, which is why it's important to watch the small caps, is the banking failures right here were a big drag on the smaller indexes. The Russell 2000 mid caps all have a higher percentage exposure to financials than they do to tech when compared to the S&P 500. So the increased tech exposure lifted the S&P 500. The increased financials exposure dragged this down, has kind of kept a lid on it. So if we see the Russell 2000 break lower, it's probably because the financials are breaking lower. We'll talk about that. It's really one of the most important things for us to pay attention to. Looking at multiple assets together, this sort of visually just shows what I talked about. S&P 500, emerging markets balanced, Russell 2000. This balanced portfolio is just a Morningstar balanced index. And then long-term bonds via TLT, the ticker. what we see is that the vast majority of assets across the globe are up kind of 0 to 4% for the year. The S&P being up 11, 10, 11%, NASDAQ being up a little more. Those are the outliers when it comes to the cross asset classes. Most everything is really quite flat and quite choppy. Let's watch what happens here. Speaking of what to watch, I think this is the most important data point that we need to watch over the next 6 to 9 months. It's the distressed status and delinquency rates in commercial real estate. What this tells us is that for as of August 31st, all of the commercial real estate loans that have matured, 18% are still performing. That means 82% are under some sort of distress. 43%, this orange section, are in default. They're not performing. They're late on their payments and they're not making payments at all. So they're considered in default. 82% of commercial real estate loans being in delinquent status is a big potential risk. Most people think this is isolated into the office space. But what we can see is that office has accelerated, the distress rate has accelerated quite a bit, but it's not just isolated in office space. The two areas that are really performing well, industrials and self-storage, those are strong areas. Office here in the pink, we went from a 3% distress rate to almost 9.5% distress rate. This is a big move higher. Lodging, so hotels, really big spike higher in COVID. We consistently moved down lower to about 5.5%. It's back up to 8%. Retail has been in distress for multiple years. What's surprising to me, frankly, is multifamily. So this shows we went from a 1.5% distressed rate a year ago to now 5% on multifamily. That is a big number, and it frankly was quite surprising. It's more it's less of a reflection of the quality of the underlying real estate asset and more of a function of banks are not lending to commercial real estate projects, period. I have a friend in Austin, runs one of the bigger firms. They're trying to get a multi-use facility done at a fantastic location in downtown Austin. They've gone to 45 banks that all have said no, and we're not even going to look at it. So there is a lot of stress in the commercial real estate market. The question is, does the stress in commercial real estate feed itself over to stress in bank balance sheets? So if banks have to start marking down their loans because the loans are technically in default and banks are very highly regulated entities, that's going to cause problems. I think with the bank earnings that are coming out this quarter, the most important thing to look at is, do they start taking credit reserve losses? Do they start to have loss reserves for commercial real estate debt? If it can stay isolated, if it can stay a localized banking problem and localized commercial real estate problem, it shouldn't spread. If it does start to affect the balance sheet, I think that increases the risk of some sort of mini financial crisis. Maybe not 2008 level, definitely bigger than March when we just saw a few banks fail. But it doesn't have the same extent as 2008, but it could cause problems. Something to really, really watch over the next 6 months. On the flip side of it, some positive things are GDP. So the GDP, Atlanta Fed has a GDP Now estimate that looks at a lot of real-time data to say what is the current quarter GDP to projected to come in at. They're saying it's almost 5% GDP. This is a dramatic shift from earlier this year when almost every indicator was pointing to a recession starting over the summer, and we just simply haven't seen it. So this is the blue chip consensus. The big banks are forecasting a 3%. They started the quarter at a 0% GDP projection. We're now at 3% for the big guys and all their ivory tower folks. If we come in 3 to 5%, and especially if we come in north of 5%, that would be one of the strongest GDP quarters since 2003. Just goes to the strength of the consumer. It's a positive that we need to watch, and this could lead itself to a strong fourth quarter rally. Bigger picture, the overall picture looks much more balanced than it did 6 months ago. Like I said, 6 months ago, there were many data points with very high success rates historically of predicting recessions that were screaming recession. It just hasn't happened. So what it looks like is that it's a little bit more balanced. The risk of a major bear probably coming from some kind of commercial real estate domino that might fall is about balanced with a major bull, kind of a new longer term bull market. So we've got those two sides of the equation look like fairly equal probabilities, but still low probabilities. The sideways chop, a long-term, multiple year, 5 to 10 years of a choppy sideways market is really becoming more and more a probability. It's what happened in the 70s. Last time we had rising interest rates and persistent inflation in the U.S. economy, markets were flat from 1968 to 1982. The conditions are very similar today with the late 60s and early 70s. Something we really need to watch. If we go into this, we're starting to make preparations for that. We're putting things in client portfolios to take advantage of that scenario that could happen. The main thing we're doing is we want to focus on yield. Have increased cash holdings. Cash is paying over 5% now. Pipelines, we've had that in the portfolio for a number of months, looking at high dividend stocks. There's going to be some opportunities in longer duration bonds here in the not too distant future. Private debt, we've already started to have some conversations with clients on private debt. We'll continue that over the next 3 to 6 months. So look at if you can get yield in your portfolio in a long-term flat choppy market, you're gonna continually make progress towards your financial goals. So if we're going into this environment, which we do think is a likelihood at this point, we need to have yield and we need to be less dependent on overall growth. So a lot of different things. There's some important data points that are going to come out in the fourth quarter. Inflation, the GDP, like we talked about, the bank earnings. Let's watch that and let's hope that this correction's about over and that we could see a nice, strong fourth quarter. But as always, we're going to watch for something else happening. So if you have any questions, please don't ever hesitate to reach out to me directly, jim.denholm@ironbridge360.com. I tend to post most often on Twitter @denholm_Jim, and then we'll post the video on our website later today or tomorrow, ironbridge360.com. So thank you for listening and invest wisely.